So, yes, good afternoon. So, I hope, guys, all of this which we saw day before yesterday was comfortable. We saw advantages and disadvantages of NPV, test your understanding 5, annuity, illustration 2, test your understanding 6. Have you all attended that class? Niharika, Anjana, Kittu's left, I don't know. You were there. And Niharika, were you there? Yashika, were you there in the day before yesterday's class? Kenny, were you there in the FM class day before yesterday? Okay, so you watched the recording, Niharika. 3:30 is what? Only half of the class you attended. So obviously, what is in red, you will not be able to understand. Guys, make sure if you miss out on a class, you definitely watch the recording because obviously, in order to proceed, you to understand the previous class. Anyway, now, as you all know, uh, from the earlier class, I explained everything and I said that in order to do advanced annuities, yes, please, okay. In order to do advanced annuities and perpetuities, and in order to look at advanced IRR, we will basically, I'll give you some time first so that you understand annuities and perpetuities. And once that has happened, we can look at advanced and delayed annuities and perpetuities. But today is a good time to start advanced and delayed annuities and perpetuities. What is advanced annuity? Technically not be in today's topic. This is actually from day before yesterday's topic. Advanced annuity is where normally so far in this chapter, what did we see? We saw that whoever is investing, they get returns after the first year. I still see people are still joining. Osama is here, Jigyasa is here, Anjana, Niharika, Yashika, good. So normally, so far in this chapter, we saw that whoever is investing, yes, Anjana, thanks for kind of pointing that out. Let's start with, oh, I think Kittu. Kittu, can you tell me a little about can you calculate test your understanding 5 Kittu? How to do this? What to do? How do we solve? Next question will be to Osama. Osama, your question is in general, what is IRR? What is internal rate of return? So for Kittu to see this question, you have test your understanding 5 here. Osama, tell me what is in general, what is what? What is internal rate of return? Let me type. Okay. Now again, only those who don't have access to Harmeet Singh, I'm seeing you for the first time. Have you watched my previous recordings on FM? Today is 26th, and I believe 1, 2. What? This is only the third class. 1, 2. No, this is the fourth class. 3 classes are over. So Harmeet Singh, have you watched the previous recordings? Harmeet Singh left. Okay. Yes, Osama, I'm waiting for your answer. Yes, Kitu. So IRR is the discount rate at which our NPV of an investment is basically zero. Break-even cost of capital. Okay, very good. Very good. Nicely put, Osama. Yashika has given me the answer for test your understanding 5. Kitu, you're slow. You need to pick up. People are giving me answers in private. Oh, okay. Your internet is slow. So Anjana also has given me the answer direct message. This is not an annuity. This is a normal cash flow that we are getting. 10,000. Again, I think you are struggling with opening your discount factor table. Also, guys, today the FM textbook will be uploaded on the LMS. So for those of you who don't have the access, and also this textbook is valid until June 2025. So don't worry, there is absolutely no problem. We have to calculate future value. No, no. Yashika, we have to calculate the present value. Oh, sorry, you're right. What amount should be invested now to receive 10,000? Yes, yes, Yashika, you're right. 7350. Yes, Kitu, that's absolutely correct. Now, I think I'll ask one question to who can I ask? Jigyasa, I will ask later. Probably Anjana. Okay, what is the topics that I covered? Can you tell me a little about can you help me solve test your understanding 3? All of you try it. Let me know who gets the answer first. Test your understanding 6. A payment of 3,600 is to be made every year for 7 years. So it's definitely an annuity. The first payment occurring in 1 year's time. Okay, easy. 1, 2, 3, 4, 5, 6, 7 years. What is the present value? So 3,600 into the annuity factor at 8%. Very good, Osama. That's right. Anjana, yes, that's right. Okay. Now, again, it's 2 9 p.m. Indian time. And we will now start off with uh, today's class, which talks about everybody is getting the right answer. Yes, Anjana, you can always ask a question.
So the textbook will change for the September attempt also?
Could change, but for June attempt, there is no change. So this version, this textbook that I'm using is valid until June 2000.
Okay, sir.
Generally, it doesn't change. Like I'm using the same book, even the older version was the same thing, which I literally the content is the same. I have the old version also, and it's literally the same thing. So unless there is a major change, or unless you know, for example, in tax, there are some changes, right? So there, yes, there will be a difference. So I have the tax book until March 2025, but I cannot use the same book for June 2025 because there's a change. But I have the FM book until March 2025, and I have this one, which I'm using now, is the FM book until June 2025, and there's absolutely no difference in both.
Okay, sir.
Doesn't very often. Yeah, that's what it do. It doesn't really change. It hasn't changed in quite some time. Okay, so now it's 2:10, and now today we're going to look at advanced and delayed annuities and perpetuities. We all know, again, for the sake of those who are not there, we all know an annuity is an amount that you get every year for a fixed number of years. A fixed amount you get for a fixed number of years. is a fixed amount that you get every year for a fixed number of years. This is what an annuity is, right? So, what is an advanced annuity? See, sometimes it's like this. I normally get my salary at the first of every month. Sorry, not first, fifth of every month. Of every month. But this month, we have a festival. Most likely, as I said, Monday there may be no class. I will let you know Saturday evening whether Monday there's no class or Tuesday there's no class. I'll confirm that Saturday evening, right? But this month we have a festival, right? And this month, because we have a festival, I am getting my salary in advance, right? Instead of getting it on the 5th of every month, I will get it on, say, this month, I'll get it on 30th, not 30th, maybe 29th, tomorrow, right? So that is that if it happens with an annuity is an advanced annuity. Normally, you get your annuity at T1 that is after 1 year. In the second year, you get after 2 years, you get an amount. After 3 years, you get an amount. After 4 years, you get an amount. But you always get the amount after 1 year. There was an assumption so far, with respect to annuities, there was an assumption that we get the first payment after 1 year. But this isn't necessarily always true, right? You might even get the first payment now. So this isn't necessarily always true. You might get your first payment now as in T0 time 0 today. If this happens, your annuity is in advance. Your annuity is received earlier. This is an advanced annuity. So the topic name, Kitu, is advanced annuities and perpetuities. Okay, very good. Please, guys, make sure you have an index like this because it will help you. Okay, 26th of March, what did this guy come and teach me? These are the 14 topics. On 24th of March, what did we teach? These are the topics. So you can topic by topic see if you're comfortable with everything. But I haven't put it in 28th because it still falls under the category of 26th. Once I complete this, I will highlight this in green. Okay, so your annuity is received earlier, and this is an advanced annuity, right? So I hope everybody, and obviously perpetuity also, it's the same thing. The same logic applies to perpetuity as well, right? You might get your money now as in time 0 also. Okay, for example, no need to look at the solution and panic. But for example, a 5-year 600 annuity is starting today. Interest rates are 10%. Find the PV of the annuity. What I can do, how can I simplify your life in this? Is this. See, it is an annuity, there is no doubt. And the amount of the annuity is $600. No doubt about it. And normally, we know the interest rate is 10%. And we know it's a 5-year annuity. Right? This is something we've already calculated. So you can easily calculate the annuity factor and you can easily get what? You can easily get the present value normally. But the only thing, the only difference in this specific chapter is what? The only single difference, one single difference in this specific question is that you get the first payment. First payment is received now. Now means time zero. So whatever is the only change or only difference, again, I'm closing the textbook, is in red. This is the only one single difference in the question compared to what we did earlier. Okay. Now, what happens is we will assume that there is no such thing as an advanced annuity. So what I will do is I will open my annuity factor table, right? And if I open my annuity factor table, it is how much? 10%. Was it 10%? 10% for 5 years. Yes. So 10%, again, this is how you spot it for those who still don't know. 10% is here, 5 years is here. So just move your finger along that line. The annuity factor normally is 3.791. Okay, it is 3.791. 10% 5 years, right? Yes, so it is 3.791. That is what you will normally do. Correct? But in this case, what is happening is because it is a 5-year annuity and you're getting now one amount, time one, you get 600. In the second year, you get 600. In the third year, you get 600. And in the fourth year, you get 600. Basically, these are the 5 years. The 5 years when you will get the amount is time 0, time 1, time 2, time 3, time 4. That's it. See, 1, 2, 3, 4, 5. So because the first amount is received now, we will take the annuity factor for only the other 4 years. Because the first amount is received now itself. You understand? So in this case, what you will do is you will, where is it? Where did my table go? You will basically, in this case, because you know that the first amount is received now, and there are only 4 years left. Year 1, 2, 3, 4. You will, in this case, what you have to do is, again, I'm putting that in green, because only time 1, time 2, time 3, time 4 is left. In this case, you will find your annuity factor here, 3.170. Again, what is in blue is what you would do normally for 5 years if you get your first payment in 1 year. But if there is an advanced annuity, first amount is received now. So the remaining years are only 4 years. So what I've put in green is what you will do if there is an advanced annuity, right? So I'm going to remove that. So what I've put in green is what you will do if there is an advanced annuity, and therefore what you will do is, again, the annuity is how much? The annuity factor we saw was 3.791. 0.17. Right? This is for how many years? Again, I'm putting it in blue. This annuity factor is actually for 4 years. That is time 1, time 2, time 3, time 4. Remember this. For the fifth year, basically for now, the discount factor, annuity factor for something that is now is 1. I mean, there will be no discounting that will happen. So it's like you just add 1 to it. Because remember, we've said earlier in yesterday's class also that the discount factor for time 0 is always 1. Remember, I told this again for those of you who are confused. If the future value, I've said this, time 0, if I'm investing 10,000 now, what is the value of that now? The cash flow is 10,000. What is the present value of that now? Present value, again, I'm putting 10,000 now. So what is the value of that now? Same 10,000. So I told you yesterday in the last class that the discount factor or annuity for any cash flow in time 0 is always 1. 10,000 into 1 is 10,000. Right? Is everybody able to hear me properly? There's no disturbance. Just confirm, please.
No, sir.
Clear? Yes? Okay. So in that case, here the annuity factor becomes 3.17 plus 1, which is 4.17. So you get the annuity factor. And once you've got the annuity factor of 4.17, you will simply multiply it with what? You will simply multiply it with the cash flow of 600. Because you remember I told you yesterday, how will you get the present value? Future value into annuity factor. Future value into discount factor. So this is the annuity factor. This is the future value. So if you multiply that 600 with 4.17, it is 600 into 4 should be 2,400 something. But again, because there is 0.17 here, the precise answer is 600 into 4.17. The precise present value is 2,502. So I hope this was not very complex and very simple. Okay, so this is how you deal with advanced annuities and advanced perpetuities. Now, if you've understood advanced annuities, advanced perpetuities would be the same thing. Just add 1 to the perpetuity factor, just like how you added 1 to the annuity factor, and multiply it with the future value. So if I have to tell you how to deal with advanced annuity, add 1 to the annuity factor for the remaining period of time. The remaining period of time was 4 years. So you take the annuity factor for 4 years and just add 1 and multiply that with the future value. Same way how to deal with an advanced perpetuity, how to deal with an advanced perpetuity. How do you deal with an advanced perpetuity? Again, you add 1 to the perpetuity factor for the remaining period of time. Multiply that figure with the future value. And we can prove that here in this illustration also. A perpetuity of 2000 is due to commence immediately. So again, it is an advanced perpetuity. It's not coming in 1 year's time. The interest rate is 9%. And we've seen in the last class that the perpetuity factor is 1 divided by R. So what did we do? Future value is multiplied with 1 divided by R. But to that, perpetuity factor, we have added 1 using the same common sense, using the same logic. And that's why the answer is 24,222. Slightly confused. Okay, I will help you. How will I help you? Again, going back to annuity factor. What is happening in this case? Here, basically, it's very, very simple. You are normally what is happening is annuity factor, sorry, present value is equal to annuity factor into future value. This is what you will normally do. So what is normal is I will put in green. And normally you will receive the first amount in 1 year's time. First amount is received in 1 year's time. So you just implement that in the, just use the annuity factor table to find the annuity factor. So suppose if this same question said that you get the first payment in 1 year's time, you will say time 1, time 2, time 3, time 4, time 5. Basically, this is when you will get the payments. How many years are there? 1, 2, 3, 4, 5. So you will simply take the annuity factor for 5 years at 10%. Normally, again, I don't mind explaining again. Normally, I'm putting it in blue, 10%, 5 years. So you will take an annuity factor of 3.791, right? And you will multiply the future value. How much is the future value? You're getting 600. So 600 into 3.791. This is what we saw in the last class. So 600 into 3.791 is 2,274.6. This is what normally happens. But in this case, there is an advanced amount received. The perpetuity is advanced, meaning, again, the formula will remain the same. I'm putting it this in green. Right? The formula will remain the same. It will be present value into present value is equal to annuity factor into future value. This is what the formula is. But in this case, first payment is received now, that is in time 0, right? So in this case, first payment is not coming in time 1. There is also time 0 involved. First payment is coming in time 0 and the remaining payments are coming in time 1, time 2, time 3 and time 4. Why only I have only taken till time 4 is only 5 years you are getting this amount. Time 1, this is 1 year. Time 0 is 1 year. Time 1 is 2 years. Time 2 is 3 years. Time 3 is 4 years. And time 5 is 5 years. So see, 5 years are over. So in this case, you will only take till time 4 because you are getting the first payment now. That is in time 0. So in this case, what you will do is you will simply find the annuity factor for time 1 to time 4. Right? How will you find the annuity factor for time 1 to time 4? Here is my textbook. Again, you will simply take, I'm putting this in green, 10%, but you only want time 1 to time 4. That is, here you will stop at time 4. So you will get the annuity factor as 3.170. Right? So the annuity factor is 3.170. And this annuity factor is for how many, what period of time? It is for this period of time. Time 1 to time 4, it is 3.170. So you got the annuity factor for this period of time which I have highlighted. And always remember that for time 0, the annuity factor, discount factor will always be 1. Therefore, the revised annuity factor in this case is for time 0, it is 1. And for time 1, 2, 3, 4, the annuity factor is 3.170. So in this case, the 5-year annuity factor is 4.170. And now that you have the annuity factor, implement that or apply this in this formula. You know the annuity factor, it's 4.170, and you know how much is the yearly cash flow. The yearly cash flow is 600. So multiply 600 into 4.170 because the future value is 600. So 600 into 4.170 is 2502. Is this clear to everybody? Including the one who asked me the doubt? Yes. So advanced annuity and perpetuity is done. Now what we are going to look at is delayed annuity and perpetuity. Guys, just a small update. My team has, yes, Yashika, that's absolutely right, has just notified that the textbook has been uploaded on there. Now, the next task for my team, as they are sitting here and smiling, is to upload the kit. So, in that folder that I shared with you, the kit is there for all the papers. Guys, just give me 1 second. So, guys, today all the kits FM, AA, FR, except for tax. No, keep it separate so that it'll be easy for them for catching it. Except for tax, upload everything. FR, FM, AA, and what is the other paper? TM. Kit. Separately, you showed kit is separate, textbook is separate, so they can easily differentiate. Coming back to the ones who are talking about tax. So the reason I've asked not to upload tax is because tax syllabus has changed, right? And many people, not only we, many people still did not get the latest version. But I know what the syllabus changes, so we're taking the classes according to that. But anyway, textbook is already uploaded. Kit will be uploaded within the next few minutes before your class is over. You will have the kit uploaded. And yes, as all of you are anticipating, delayed perpetuity is where you get your salary late. For perpetuity, we do the same calculation. No, the calculation will be, what will the calculation be in that? No, definitely not. This is a little more interesting. Delayed annuity and perpetuity is a little more interesting than, I think, advanced annuity and perpetuity was a little boring. But delayed annuity and perpetuity is a little more interesting. Okay, first of all, what is a delayed annuity or perpetuity? Again, normally you get your first inflow at time 1. That is, after 1 year, you get your first inflow of cash, time 1. Right? But it's not necessary that that should happen. In business, it is not necessary. Maybe you invest today, but you get the first cash flow after 3 years. That is a delayed annuity or a delayed perpetuity. For example, let's look at an example from your textbook itself. A perpetuity of 2000 is due. No need to, please don't look at the answer. A perpetuity of 2000 is due to commence, sorry, here. Okay, here, even if you look at the answer, I don't think you'll understand. That's why I'm telling you, don't look at the answer, don't look at the solution. What is the present value of 200 incurred each year for 4 years starting in 3 years' time? So you see what is happening? This amount of 200 is received. Now incurred, received is the same thing. But for the sake of uniformity, I'm just saying received for 4 years. This amount of 200 is received for 4 years. So normally what will you do? Normally you will say time 0 is now, and time 1 you are receiving the first amount, time 2 you are receiving the second amount, time 3 you are receiving the third amount, and time 4 you are receiving the fourth amount. So this is what you will normally do. Again, normal, whatever is normal, I'm putting it in green. So you will find the annuity factor for 4 years, 1, 2, 3, 4, and just calculate. But in this case, what does the question say? The question in this case says that the first amount is received when? After 3 years. The first amount is received in time 3. You understand? So we are receiving the first payment only in time 3. This is what is happening in this case. Here's 3, 4, 5, 6. Yes, Yashika, that's absolutely right. So what will I do and how will I find the value of this amount today in time 0? How will I do this? What will I do? Right? Here in this case, all of you listen very, very carefully. Okay? How will I calculate? There are 2 ways of calculating this. I'll tell you the easiest way first. We will assume what? We will assume that time 2, again, it's an assumption, okay? Whatever I'm putting in red is an assumption. I will assume that time 2 is time 0. Just close the door. Time 2 is time 0, and I will assume this. This is an assumption I'm making. It's not the reality. I'm just assuming. Right? So if we go with our assumption, we now know how to calculate the present value. How will I calculate the present value? As usual, I'll open my annuity factor table. And what is the percentage? How much is the percentage? 5%. 4-year annuity. Where did my textbook go? 5%, 4-year annuity. 5%, 4-year annuity. So it's going to be 3.546. Right? So what will I do? I will take 3.546. Right? And I will say 200 into 3.546. Again, remember the assumption is what? The assumption is time 2 is time 0. It's an assumption. Time 3 is time 1. This is an assumption. It's in red, so it's an assumption. So given that assumption, what was the discount annuity factor? It was 3.546. right? So what I will do is 200 into 3.546. How much is it? 200 into 3.546 is how much?
709.2.
70, 200, yes, 709.2. 709.2. Now what I will do is, I know this is a figure I've got, meaning that the value of this 200, 200, 200, 200 received in time 3, time 4, time 5, time 6, it has a value in time 2 of 709.2, right? So in time 2, the value of this 200, 200, 200, 200 received is how much? 709.2. So it's like you've got the answer. Now that you have got the value of this 709.2, after this, it's a normal discounting question. After this, it's like saying you are receiving 709.2 in 2 years' time. The discount factor is 5%. Now it becomes a normal discounting question, not annuity. You're getting 709.2 in 2 years' time. The discount factor is 5%. What is the present value? So in this case, what will you do? You will open the discount factor table. How much is it? 5%, 2 years, right? So 5%, 2 years will be 5%, 2 years. Just follow the. So it's 0.9070. That's the discount factor. 0.9070. So what will you do? This 709.2 is the value after 2 years' time. So the value in today's terms is, again, 709.2 is the future value. In order to get the present value, we will multiply with the discount factor. And how much did I say is the discount factor? 0.9070 for 2 years. 0.9070. So 709 into 0.9070. So 709.2 into 0.9070 is 643.2444. 643. That is another way you can do it, Yashika. But this is one way that I really like and enjoy. So the answer is 643.2. How did I get the answer? Again, let me quickly summarize. First step in this, in case of delayed annuity, right? First step to do is assume the second year, because see, remember, payments are coming from the third year onwards. Third, time 3, time 4, time 5, time 6. So assume the T2 to be T0. You are assuming it. And as usual, calculate the present value using annuity factor. So if you assume T2 to be T0, we'll simply normally use the annuity factor table and find the present value at T2. This will give you the present value at T2. Once that has happened, now you have the present value in 2 years' time. Basically, now you have the value, I'll not say it's the present value, but now you have the value in 2 years' time, which is again future value. You will simply use the discount factor to find the value of it in T0. So simply as usual, going back to chapter 2, basics. That is another way, yes. Right, but again, generally, you need to understand what is happening, where it is happening. I'll explain to you that method also. I'll explain both the methods. Whichever is okay for you, you can do it. Right? So this is one way of calculating the present value in case of delayed annuity. I hope this method makes sense. So somebody, again, remember, don't study to pass the exam, study to gain knowledge. So somebody who is using this method, you need to know what this method is and what is the common sense and logic behind this method. Right? Did everybody understand the logic behind this method? Yes or no? Just let me know. Yes. Now we will look at the second approach, which I don't know if you find easy, difficult, I don't know. But again, these classes are happening so that you gain knowledge. It should help you in your job. It should help you in the future. Maybe the second method is easy. Let's quickly look at that. And the second method is this, where what we do is, again, look back at this question. It says that you are receiving how much? 200 each year for 4 years, starting in 3 years' time. So again, this same thing will apply. So basically, there are 6 years there. Right? So I'm going to remove all this. Technically, there are 6 years. So what you can do is calculate the annuity factor for 6 years. Okay, so how much is the amount you're receiving? Your amount you're receiving is 200 into the annuity factor for 6 years. What is the annuity factor for 6 years at 5%? The annuity factor for 6 years at 5% will be this. Anyway, so let's count and do it. 1, 2, 3, 4, 5, 6. So it will be annuity factor will be 5.076. How many years is it? 6 years, right? So 1, 2, 3, 4, 5, 6. But I think okay. For whatever reason, I'm not able to zoom it properly, or maybe we have to expand this. $5.076. Okay. So what do we do? 200 into 5.076 is the annuity factor for 6 years. But in that, the first 2 years, because you don't get any money and you don't receive 5.0 something, 5.076, first 2 years annuity factor you will deduct. So the first 2 years annuity factor is 1.859 and 1.859. Right? So you deduct that first 2 years annuity factor is 1.859 1.859. So you will deduct it. So if you deduct from 5.076, if you deduct 1.859, if you deduct, how much is the balance? What is the annuity factor? The annuity factor 5.076 minus 1.076 minus 1.859 is 3.217. So this annuity factor, remember, from 6 years, what I've put in red is the annuity factor for 6 years. Did I take 5 years or 6 years? I took 6 years. Yes. So 6 years annuity factor I'm putting in red. Yes, Babu, all uploaded. FN, FR, AA. Guys, the good news is that you now have the kit also uploaded on the LMS. So 5.076 is the annuity factor for all the 6 years. 1.859 is the annuity factor for the first 2 years. It's in purple. So the remaining of that, whatever is remaining, I think I'll put it in green. The remaining balance will be the annuity factor for your 3, 4, 5, 6, which is 3.217. So 3.217 will be 200 into 3.217. So 200 into 3.217 is 643 point. Did we get the same answer last time also? Yes, we did. Right? So I hope both the methods of calculating delayed annuity in perpetuity is clear. Short note of the colors. Yes, I will do that. I've never done this. Make a short note of colors, but I can do it. Red is basically the red is what? Red is the annuity factor for 6 years, basically from year 1 to year 6, which is 5.076. It is marked. Purple is the annuity factor for 2 years, that is year 1 and 2. Okay. Then the remaining, obviously, the difference between the two is green. Green is the annuity factor from year 3 to 6, 3, 4, 5, 6. Right, which is basically the difference between red and purple. Annuity factor for 6 years minus annuity factor for 2 years. See, the annuity factor for 6 years was 5.076 minus the annuity factor for 2 years was 1.859. So green is the annuity factor for 3, 4, 5, 6. Okay, so I hope this is clear and comfortable to everybody. Okay. So when it comes to the method, again, you can use whichever is comfortable for you, unless it is specifically mentioned that, you know, we are expected to just do 6 minus 2 or something like that. Is there anything you want to tell me? Okay, so guys, I hope this is over. And with that, we have now finally completed. Unfortunately, we haven't started today's class, technically speaking. We've just covered what was to be completed in the last class. Right? With that, finally now 3 chapters of FM are over, and we will now move to the 4th chapter. So again, we have to basically look at investment appraisal, further aspects of discounted cash flow. This is what we are going to look at technically on 20th of March, which is today. This is the topic that needs to be covered. So, what does this chapter have? What does this chapter say? We're going to look at. Again, guys, in your textbook, although it mentions that there are 22 chapters, technically there are only how many? 20 chapters. And we've come to the 4th chapter. And ideally, I would want that, again, Monday, if it's an off, then today, that's it. But by next week, I would want that we've completed at least 9 chapters out of 20. Right? And before I move on, yes, both these methods will be applicable for delayed perpetuities also. And Osama, can you repeat what to do when it is delayed perpetuity? Again, delayed perpetuity also, what will you do is, again, both these methods, either of these methods can be used.
It's 3 o'clock.
So, for example, a perpetuity of 14,000 starting in 10 years' time. It's a perpetuity. So, you will take the perpetuity factor. Okay, whatever is the perpetuity factor. And what do we look at? Again, the approach has to be the same. The logic has to be the same. But how is it different? How is it going to apply to the question? We will look at. I will do not illustration, this additional question, perpetuity of 14,000. I'll do this, right? But again, as I was saying, what was I saying? Yeah. We've uploaded the textbook and the exam kit. Okay. In addition to that, we will also be uploading the BPP kit. And obviously, all of you already have access to your study hub practice questions. Right? Is there anybody in this batch who wants to be registered with ACCA? Because if that's the case, you have to let us know as soon as possible. We will help you, but don't sit until the last minute. Right? But everybody, I'm assuming most of you have access to your study hub. So you know where to access the practice questions on the study hub as well. Right? Now, what will happen is 2 things are going to happen. First is there will be a test assigned on the LMS every Friday. This Friday, that is today, I did not assign a test on the LMS, given that this is just the 4th class for you. So only 3 classes are over, right? And 3 chapters are over. So technically, we are going at an average of 1 chapter per class. Right? So every week there will be a test uploaded on the LMS. This test will test you on the textbook, the Kaplan kit, the BPP kit, and the study hub practice questions. What do I mean by that is there is no waiting until the last day. There is no waiting until May to start the exam kit. We want you to start studying from Kaplan, PPP, study hub practice questions, everything today itself. Such that by the time the syllabus is over, your textbook is over, your Kaplan kit also fully you have completed, your BPP kit also fully is over, and your study hub practice questions are also entirely done. So that the last 20 days or so before your exam is just pure hardcore revision. Now, how can we help you in this? From the coming week onwards, we will upload videos of us solving exam kit questions. So again, I don't want to wait until I finish the syllabus and then do the exam kit. And I don't want to start the exam kit in class because totally I'm getting only 9 hours with you every week. And already we started the batch comparatively later by the time everybody joined and all that. So every week we will be uploading a good amount of questions that we are practicing from the exam kit. I will randomly practice questions from Kaplan kit. Some questions I will practice from BPP kit. Some questions I will practice from Study Hub practice questions. And all of this will be uploaded on the LMS. So your job is not only to attend the class and study it, but also at the same time watch those recordings. Be comfortable with solving exam kit questions, whether it's Kaplan, whether it's BPP, or whether it's the Study Hub practice questions. You have to be very comfortable. A few questions we will practice, and the remaining questions you will do. You will practice on your own. And with that, you will prepare for the Friday's test. So in the coming Friday, we might test you on at least 5 chapters, first 5 chapters from the textbook and from all the kits, Kaplan, BPP, Study Hub, right? And you will also be tested from the Study Hub quizzes. Every chapter, at the end of each chapter, there is a quiz. So you will also be tested on that, right? Whether it's Kaplan, BPP, or Study Hub. Because I would want somebody to score a rank in this batch. I don't know who is that person, but one person I want as a rank holder. So the first thing is to understand the concepts well, which I hope we are. But the second thing is from day one, enough practice. Okay. So I hope this is clear to everybody. Okay, so once the test is assigned on the LMS, you will be informed. Okay, so that kind of give me 1 minute. Again, I'm giving instructions to my team right in front of you, so you know how it works. Okay, Babu, so we have assigned tests for CMA batches, ACCA BT assigned. So they need to be informed that the test is on the LMS. Okay, they have time until Monday 11 a.m. So you people also, you are listening, you are hearing what we're discussing. Until Monday 11 a.m. you have time to do that test. After Monday 11 a.m. it will go. So before Monday, what happened? Duration is still Monday 11 a.m. The LMS exam answers will be checked and feedback given. Yes. In fact, it is like autocorrect. You will instantly get your marks. So, Babu, what I want you to do is draft a message, like a nice message, saying that, dear students, your test has been uploaded assigned on the LMS today at this time. What time you assigned it? Mention that time and say that till Monday 11 a.m. you can. No, I know, but we have to inform them. So draft a message and show me that message. Once I say okay, you send it in all the groups for whom the test is assigned, not for other people. Don't send it to these people. FM people, they don't have this. So for those people for whom it is assigned, for them, only in those groups you send a message. But make a draft and show. Okay, so this is how it will work, guys. So we will once, as you can see, I've told Babu, who is working very hard to ensure that the LMS journey is very clean and clear for you. As I said, I've told him that as soon as the test is assigned, you have to be informed. Friday, you will be informed that the test is assigned, even though you know every Friday test will be assigned. You know this, but still we will inform you on Friday. And until Monday, 11 a.m., the test will be open. Right? So that is how this will work. Now, technically speaking, unfortunately, we're starting today's class only now. We're moving to the fourth chapter, which is on investment appraisal, further aspect of discounted cash flows. And what does this say? I want you to all read this and let me know your understanding, or let me know what is your rating out of 5. I haven't explained it, I know, but just read it. And based on your reading, how much would you rate your understanding out of 5? 5 means you by reading itself, you understood it perfectly. 0 means you didn't understand anything. Yes, Osama, we'll do it. I'll come back to it. We'll definitely do it where we will solve a delayed perpetuity question. Can you read this and let me know your rating out of 5? Quickly, everybody. Ideally, I would want to finish this chapter today. So that fifth class, fifth chapter. How much would you rate your understanding out of 5? It's okay to give 0 because I haven't explained it. It's fine. Itu has given Yashika as 3.5. Anjana is 1.5. There are people who are at, yeah. So now I will explain this to you and simplify this for you. Okay, so let's get started. We have 15 minutes before the break, and we will now basically finish before we go for the break this part. See, when you invest money, you invest it so that you will get returns later. Yes. So say I invest 500 rupees. When I get a return, I would expect a return of more than 500, correct? I would want to make money. I don't want to just invest 500 and get back 500. I want to make money, right? So I expect a return and I say, okay, I want a return of 300, meaning that I want back 800. Yes, Kitty. That's right. Okay. So this is the actual return that I'm looking for, right? When I invest in a project, I actually want that project to give me back money, give me back a real income, a genuine income, right? So this return is known as a real return. So in this case, my real return is 300. Yes. Apart from this, what do I want? I also want extra money, I expect not only, see, 300 is what I want. But apart from that, I expect extra returns apart from the 300. Extra returns I expect apart from the 300. Why? 300 is what I want to earn, yes. But apart from that, I want some extra money. I want extra money apart from that 300. Why do I want? No, Kittu, profit is 300, no? The real profit that I'm expecting is 300. But apart from that, I also want another return. Why? Because remember, all of you just please fold your hands. I'm getting this 300 after, say, 5 years. 300 is my profit. You people will say, yeah, 300 in 5 years is a good thing. We're all happy. You people will be very happy. 300 in 5 years we are getting. Yes. But the thing is, in 5 years, what will happen to the value of money? What will happen to inflation? What will happen to prices? In 5 years, 300 rupees will not even get me maybe, for example, it will not even get me one meal. Now, in 300 rupees, I'll get one meal. But in 5 years, in 300 rupees, I'll get nothing. So, yes, I want a return. I want to make money. Yes, I want 300. Obviously, I'm investing in a project. So, I want a return, no doubt. But who will consider the fact that there will be inflation? When I get 300 rupees after 5 years, because of inflation, I'll not be able to buy even one salad. I'll not even be able to buy one burger. Because of what? Inflation. So, yes, I expect a return, no doubt. That is the real profit that I want. But apart from that, I also expect returns apart from that 300. Why I want extra money apart from that 300? This is to cover up, to make up for any price rises. In the future, after 5 years, when I get 300 rupees, it should not be like, oh, that 300 rupees, I can't even buy one bottle of Coca Cola. I should, I should also take into consideration that in 5 years' time, there will be a rise in prices. So, the first return I expect, where I want the profit, I want to make money. The first return I expect is the first return I expect is the return that will actually really help me make money. This is the real profit. The profit that I make from the investment. But apart from that, I also want the second return I expect is the return that will cover up and make up for any price rises. The first return that I'm expecting is known as what? It is known as the real return. And the second return that I'm expecting is what? The additional return to compensate for inflation. The additional return I want to compensate for inflation. Just now, I hope this is clear. Yes, you can. Inflation cover up profit could be a little misleading, but it's basically the money that is needed. The return, inflation cover up return. The return to cover up your inflation. Yes, Ketu, that's right. But use the word return. The return to cover up your inflation. And therefore, again, what do we have? We have something known as the money return. Money or nominal rate of return. So the money rate is basically the total return I want. Okay, I want basically 300 rupees to earn back plus 100 rupees to cover up for the inflation. So basically I want 300 plus 100, which is 400. This 400 is the money rate that I want. This money rate includes both the real return that I want and, as Kitu rightly pointed out, and what was the term, Kitu? The inflation cover up return. Money rate includes both the real return that I want plus the return that I want to cover up inflation. The money rate is the total. Here in this example, the money rate is 400. Right? It includes both the real return. The real return is depicted. Remember, money rate is the total return, the total rate that you want, and that is depicted as I. Real return is denoted by the letter R, and inflation is denoted by the letter H. Wherein the formula will therefore be 1 plus I is equal to 1 plus R into 1 plus H. Therefore, this becomes the formula. Now, guys, I want you to read what I have written and also what is there in the textbook. And now let me know what is your understanding out of 5. Now tell me what is your understanding out of 5. Everybody quickly.
Sir,
Yes, Nitesh.
I have a doubt. You are writing 1 plus I equal to 1 plus R into 1 plus S, no, sir?
Yes, I'm sorry. Thanks for pointing that out. It's into 1 plus H. Okay, so who all have given me 5? Nitesh, Anjana, Jigyasa, Yashika, Kitu, Nitesh is 5. What about Osama? What about Yashika? Yes. So with that, we introduce this chapter with a bang. What do I mean by with a bang? Is basically, let's look at an example. Let's look at this illustration. An investor is prepared to invest 100 for 1 year and requires a real rate of return of 10%. In addition to that, he is also expecting what? Return of 5% because of inflation. So, what do I do? See again, in simple terms, forget the return. Forget the real return that you want. Just inflation, just to cover inflation. Inflation is 5%. So basically, 5% of 100 will be 100 into 5% of 100 is 5, guys. So just to cover the inflation, you would want how much? Cover inflation. You want a return of 5%. 5% of 100 is 5 divided by 100 in 200 is 5. 5 plus 100. So basically, just to cover inflation, you want 105. On top of that, you want a return. So you want a return of 10% on top of that. 10% of 105 is 10.5. Right? 10% return you want on this. 10% of 105 is 10.5. So you basically want 105 plus 10.5. So basically, guys, you're expecting 115.5. He wants 115.5. Why does he want 115.5? He wants 115.5. 10% he wants as a real return and 5% he wants to cover up for inflation. Therefore, the investor is expecting what? He's expecting to have how much? 115.5. Right? How much was it before? Break time. Yes, Yashika. So you can go for the break, guys, and come back by 3:35. Thank you so much. Right. It's 3:35, so we took an exact break of 10 minutes. And now we can continue. Am I audible to everyone? Just let me know.
Yes, sir.
Okay, perfect. So now we're going to look at, I think test your understanding 1 would be a good start. 1,000 is invested in an account that pays 10% interest per year. Inflation is currently 7% per year. Find the real return on the investment. See, when it comes to the inflation, inflation is how much? 7%. H is 7%. Okay, going back to this formula, H I know. And the account pays 10% every year, and you are expected to calculate this R. And how much does it pay every year? You get a total of 10%. Totally, you get 10%. It's like you're totally getting 10%. They want to know, yes, 7% is for the inflation. How much is the real return? I is what? 10%. Now, generally, what people do is they just subtract and they directly subtract and say 3%, but it's not that simple. Yes, Nitesh, that's absolutely right. Basically, you just have to go back to grade 5 maths. What do I mean by grade 5 maths? If the formula is this, 1 plus I is equal to 1 plus R, 1 plus I is equal to 1 plus R plus I is equal to 1 plus R into 1 plus h. Then all you will have to do is, here you need 1 plus r, you need how much it is. So going back to simple school mathematics, what will you do? In order to get 1 plus r, you will have to send this 1 plus h to the LHS, to the left hand side. And when you do that, see on the right hand side, you had multiplied. So when you move it to the left hand side, the sign will change and it will be divided. So the formula will become simply 1 plus I divided by 1 plus h is equal to 1 plus r. So it's extremely simple. That much simple it is. 1 plus I, you know, I is 10%. So 1 plus 10% is 1.1. 1.1 divided by 1.h, h is 7%. So 7% is 0.07. 1 plus 0.07 is the same as 1.07. Right? Therefore, the formula is 1.1 divided by 1.07. 1.1 divided by 1.07 is 1.028. 1.0280. And remember, what is this 1.0280? It is 1 plus r. So basically 1 plus r is 1.0280. So if 1 plus r is 1. Just going back, just grade 5 maths. If 1 plus r is equal to 1.0280, then r will be, you're just deducting 1, no? R will be, again, if you still want that much clarity, then you will send this 1 to the right hand side, and obviously the sign will change. So it will become R is equal to 1.0280 minus 1. So R is equal to, again, it's automatically going in caps. R is equal to 0.0280. And again, if you want this as a percentage, 0.0280, you simply have to multiply with 100. So 0.0280 multiplied into 100 is 2.8%. Therefore, the answer to test your understanding 1 is 2.8%. I mean, it's really difficult to get something easier than this. Impossible. Okay, so we looked at what is number 1, real return, right? We've looked at real return, and we've looked at test your understanding 1. Can we move on to test your understanding 2? If the real rate of interest is 8% and the rate of inflation is 5%, what should the money rate of interest be? So R is given to you. R is given to you. R is 8%. H is 5%. We need what? I. And again, we know the formula. 1 plus I is equal to 1 plus R into 1 plus H. So let this be X. 1 plus I is equal to 1 plus R. 8% is 0.08. And 1 plus 0.08 is 1.08. 1.08 into 1.05. So how much is 1.08 into 1.05? It should be, yes, Osama, that answer is absolutely right. 1.08 into 1.05 is 1.134. 1.134. So 1 plus I is equal to 1.134. Therefore, I is equal to 1.134 minus 1. So I is equal to 1.134 minus 1 will be 0.134. And as a percentage, if you want, I is equal to 0.134 into 100 is 13.4%. I hope this is very, very, very easy. I mean, again, it cannot be easier than this. Has to be some, I mean, this is just school maths that we are doing here. Okay, so test your understanding and test your understanding 2 we have completed. Okay, 1 and 2. Now, what are we going to look at? The next part of this chapter itself is inflation in more detail. The impact of inflation on cash flows. We're going to look at that, and I will try my best to explain it to you with the help of an analogy or a story or example. Right? So, how do you do this? Is again, we all know what inflation is as such. It is the rise in the price of anything, something. Rise in price, it is inflation. Now, how does inflation affect cash flows? This is something that a lot of people don't understand. I don't know why, but they don't understand very easily. Many people, I mean, people sometimes they do self-study and then they fail. And whenever I handle a fail batch is they've written the exam, they failed and come. Whenever I handle a fail batch, this, even though it's such an easy topic, many people struggle. Okay. Anybody is resitting FM? Let me kind of tell you this, explain this to you in this with this example. As of today, as of now, a dairy milk chocolate, you want to buy dairy milk Oreo, you want to buy silk. Today, if you go, the price, oh, okay, you gave last year. And how much did you score? See the price of dairy milk Oreo. Don't know why. I think I have to buy it today. Since the morning, I'm having this huge. That explains this exam. Right. 46 is a very close. 47 is close. Very, very close. So you're buying a dairy milk for 185 rupees. Okay. And what happens is there is inflation. Year after year, there is an increase in price. Say, for example, 10%. So now it's 185, that is at time 0. The dairy milk is 185 rupees. But at time 1, after 1 year, there will be a 10% increase. So it will become 185 into 1 will become, there will be a 10% increase in 1. 10% increase in 1 is 1.1. So in time 1 dairy milk will become 1.1. So it will become 203.5. In time 2, what happens is, already it was 203.5. And again, there's a 10% increase to that. So 203.5 into 1.1, one dairy milk will become 223.85. And in time 3, already it is 223.85 from the previous year. And again, there's a 10% increase. So 223.85 into 1.1 is 246.23. This is something you have to understand, that because of inflation, the amount of cash that you're paying year after year is going up. So you have one is current price. Current price is today's price. This does not include inflation. Current price is what? 185 rupees. So as per this example, the current price is 185. The other thing you need to know is something known as nominal price. This price includes expected inflation. Right? So the nominal price of a dairy milk after 2 years is 223.85. Right? And that is what has been explained on this page. So again, just look at what I'm underlining. No need to make your life very complicated. Again, if you do not adjust for inflation and just take the price today, that is simply known as current price or today's price. If you adjust for inflation, have been increased and adjusted for inflation, then that price is known as money or nominal price. See, I've mentioned it here. Nominal price. So the cash flow that is adjusted for inflation is known as nominal cash flow. Just like how a price that is adjusted for inflation is known as nominal price. So a price that is adjusted for inflation is a nominal price. Just like a cash flow that is adjusted for inflation is known as a nominal cash flow. So what I've underlined, just read it. Okay, so this is what has been mentioned. For example, if the question tells you that the sales for the next year, 3 years, are 100 in current terms, just like how I told you that in current terms, the dairy milk is 185 and is expected to increase by 10%. In year 1, it is 110. In year 2, it is 121. In year 3, it is 133. Okay. These are the cash flow these are the nominal cash flows or money cash flows. What do I mean by nominal cash flows or money cash flows? Those cash flows that have been adjusted for inflation. Okay. So I hope this page is clear, comfortable to everybody. If there is something you want help with, please let me know. Meanwhile, you can put things in your own words. And of course, you have this also, my writing also. Some other example. Sure. Some other example can be today, in order to buy something, say you want to buy anything, say you want to buy, you want to buy a seat. I'll just share with you an example that we were talking about some days back for a family friend. Right? They want to buy a seat in a college. Okay. If you want to buy, they were just planning this. They want to buy a seat for their daughter who will go to college after 2 years. We were saying if we want to buy a seat today, day itself, one seat is about 80 lakhs. This is what? This is the current price. Well, like as of today, one seat is costing us 80 lakhs. Okay, fine, makes sense. Then what? They're saying after 2 years, obviously there will be an increase. Things will become more expensive. There will be inflation. They're saying after 2 years, if we want to buy the same seat, we need more than 80 lakhs. Are you understanding? They're saying that we need 96 lakhs. This is the nominal price. Nominal price. This is basically the price that reflects the inflation or that has taken into account the inflation. Clear, Nitish? Is this simple? So current price is the price today without inflation, and nominal price is the price after certain number of years that has taken into consideration inflation. Now, Nitish, clear?
Yes, sir. It's clear.
Clear? Any problems?
No, sir.
Okay, let's continue. Now, what does this talk about? Again, probably I don't want to like get into too many details. What I'm going to do is, again, because and before you kind of lose your mind on this, I don't want you to kind of lose out. We will kind of probably look at another specific topic and come back to this specific topic. So, chapter 4, till here we've seen, we need to continue from test your understanding 3 onwards, test your understanding 4, specific and general inflation rates we have to look at. And all of this about inflation we will have to see. Right? Now, what is tax? How many of you have done the tax paper? Anybody has done tax? Oh, so many people are like yet to do quite a lot of things, I feel, because again, from what I am able to see in multiple batches, again, many people have just done one paper, two paper, that's all. Okay, anyway, what is tax? Tax is basically like the money that you give to the government. So when you earn something, you will have to give a percentage of that to the government. It's like, say, for example, simple example would be, say you earn how much? You earn 20,000 rupees. And when you earn 20,000 rupees, your father says that in this money, you have to give me 19% or say 20%. So he says, if you want to live in this house, you have to give me 20% of whatever you earn. With that money, I will run the house. Same way in tax, whatever you earn, where do you live? You live in the house, in the country. Correct? So whatever you earn, a percentage of that is paid in taxes. Right? And obviously you have to pay it in order to live in this house. In this house, in this case, it's 4 o'clock. Country. Right? So here what we are looking at is how does tax affect the cash flows. Okay. So here, what are we going to look at? Again, number one, there is something known as a relief on investment spending. What do I mean by relief on investment spending? Again, see, when you buy something, when you buy an asset, there will be like a small reduction in the tax that you pay. Again, we will look at that in a lot of detail in the tax paper. But yes, kind of like Kitu, that's right. And on the inflows, on the money that you earn, you will also pay tax on that. Right? So here what we are going to look at in taxes is how does the tax impact cash flows? How does tax impact and affect cash flows? Okay. However, here I would like to kind of just pause and show you how the LMS is going to look, because I still keep getting messages about how the LMS is to be accessed and all of that. So I would like to pause for a second and walk through the LMS. Give me 1 second, guys. Okay, guys. So this is how, when you log into the LMS, this is how the LMS is going to look. Okay. And what you will do is you will click on this. This is basically your dashboard. And you will click on this. Right. Once you click on this, I mean, you've enrolled for the FM paper. So you will click on FM. Sorry. You will click on FM and you scroll down, and over there you will find the recordings, right? So you have the recording for the first class, which is 21st of March. then the second class which happened on 24th of March. Then you have the day before yesterday's recording, which happened on 26th of March. And of course, you have the study text, which is there for you. Click on this. You have the Kaplan study text. Okay, and you have the textbook like this. As of now, we are in the fourth chapter that we are completing. And most likely by the next Friday, I would want to finish. I don't know how far it is possible, but I would want to finish at least 9 chapters. 9 out of 20 chapters, meaning like about 40% of your syllabus is over. Right? So I would ideally want to finish 9 chapters. Let's see how far that goes. Then, again, guys, is it possible to implement speed, increase the speed in the recording? We will have that checked. Okay. Then again, you go back. You will have the exam kit. So you have your exam kit also. We cannot speed up as of now. Can we speak to Gokul and kind of speed increase? Yeah, we'll do it. So you see, you have the Kaplan kit. And again, ideally, you should be in a position to start solving the kit. Okay, and again, just a few tips on the kit, guys. When you start, at least, okay, when you start the kit, it is normal to feel intimidated, it is normal to feel scared, and it is normal to kind of feel that you don't get it. And you see, you have your tables here. Yes, panic is very normal. You have your discount rates, you have your annuity factor table in this, so you can use that, right? It is very, very, very normal. What I suggest you to do is when you open the textbook, sorry, when you open the kit, say, for example, take a number of questions that you will do in your first sitting. For example, I don't know how many sittings you can have in a day, but when I used to study, it used to be like, okay, I have 5 sittings per day. First sitting will be from 10 a.m. to 11 a.m. because I didn't do anything with ACCA. I was just, I was not working. I was not, so I had time. So first sitting was 10 to 11. Second sitting could be like 1 to 3. Third sitting would be like from 5 to 6 and so on. So I used to have like 5 sittings. Now it will depend on you. How many sittings are you going to have depending on your time, right? Now, you need to take a number of questions that you will do in your sittings. Generally, I used to do 15 questions you can take, at least to start off with. Right? So you take 15 questions, and in that sitting, you just excuse me. So yes, you say you take 15 questions in your sitting, right? It's okay what you can do is you can look at the question the first time you do it, look at the question, and you can directly look at the answer. This is what I used to do at least. Because we don't have so much time to sit, look at the question, we get confused, oh, this was not there in the textbook, we panic, and the panic makes us close the book. So don't do that. Look at the question and go back at the answer and look at the answer. It's fine. It's okay if you don't know it, no problem. You should not be knowing the answer. I don't want you to know the answer. So you can look at the question and you can look at the answer. It's okay. It will save your time. But when you look at the answer, make sure that you are understanding the logic. You are understanding where did we get the answer from. Are you understanding? When you look at the answer, make sure you're understanding the answer. And that's it. Move to the second question. Same way, second question also look at the question and you should directly look at the answer. This is again what I used to do. Second question you do, third question you do, fourth question you do. You complete all the 15 questions and mark those 15 questions as complete. Done in blue. So it means one time done. You've looked at the question, you've looked at the answer, and you're happy with the answers. The second time, what you do is take the same set of 15 questions. Look at the question and do the answer on your own and refer if you need to. You can refer. If you need to, you refer. Otherwise, quickly do it. Be fast. So, okay, I was able to do the first question. I know what the answer is. I'm choosing the answer and moving on. Right? Here, I know the answer. I'm choosing it and I'm moving on. Here, I know the answer. I'm choosing it and I'm moving on. And I'm happy with the answer. Here, I'm choosing the answer and I'm moving. I know the answer. I'm moving. Here, I don't know the answer. Here, I don't know the answer. Which two of the following are examples of internal stakeholder? So, which two could it be? Company directors and employees. So, it has to be A and D. But suppose I don't know the answer. What I will do is, I will quickly refer the answer and see if I'm happy with it. Same way, complete all the 15 questions. And you have to move fast. Look at the question, see the answer, see if you're happy with the answer, see if the logic makes sense, see if the explanation makes sense, and keep moving fast. Right? Then finally, again, the third time you open the same set of questions, look at the question and completely do it on your own. Right? And again, I don't know, many people say that, oh, will this not take time? No, this actually saves time. Because it eliminates the panic. You are acknowledging the fact that you are just starting the kit. It's okay if you don't know anything. So the panic element is gone. So automatically, if the panic element is gone and confidence element is up, speed will pick up. Second, you're not sitting and wasting time. You acknowledge the fact that you are learning only. You're just starting the kit. And you're directly looking at the answer. So you're directly studying. Again, you're not mugging up, but you're trying to understand why the answer is the answer. Second time, obviously, you will do it fast. And third time, you'll do it super fast. Now, obviously, please don't do it like this. First time, I'll do the question. Second time, again, immediately, you'll do the same question. Same question immediately. And third time, immediately the same question. Don't do it that way, please. finish the entire set of questions. That 20, 25 questions, finish it once and then go back and redo it. Finish it twice, up to 20 questions you finish, and then go back and do it. Don't do it like one. Don't do the same question 3 times back to back, because obviously then you will remember the answer. So finish the set of the questions. If you choose your set of questions to be 25 questions, finish the 25 questions, master them. And you should be very comfortable with. You have a problem with theory question. What is the problem with theory question? How to know this is correct? I didn't get you. You can always refer the answers at the back of the kit.
Sir, I have a problem because the theory question is a typically. So most of time I attempt, but how to know this is the right answer? Yeah, some other.
The explanation behind the answer you're asking. Again,
Yeah,
you know the answer, you know it's option C, but what is the explanation behind the answer? Is that what you're asking?
yes, sir, yes, sir.
That's why, again, we will be uploading videos where we are solving kit questions for you. That's why I said, we'll not leave you alone like that. We will be uploading videos where we are solving and explaining why is the answer so and so. Right? Why is the answer, I don't know, D. I didn't read the questions. I don't know what the answer is. Which of the following tasks would typically be carried out by a member of the financial management team? Right? So we will explain. Right? And also at the back of the kit, you have the answers and the explanation to why the answer is so and why it is not so and so. So that is one resource. And the second resource is our videos. And the third resource is you have the hotline number where you can message and say this question I don't understand. So 3 resources you have. One, in the exam kit itself. I don't know if you've understood what I was saying here, but look at the question and at the back of the kit, the answer and the explanation is there. See if you understand it. See if you're happy with it. Then do it on your own. These 25 questions, finish it on your own. Third time, when you do it, completely do it on your own without any dependency from the answers. Once you've done it 3 times, it means you are good to go. I mean, these 25 questions you've mastered, so you can increase it to 25. It depends. If it's theory questions or if say they are easy questions, you can increase it to even 35. Once you finish that, you've mastered those set of 25 questions. And at the end of the third time also, if a certain question is, you don't understand the logic behind that question, you don't understand the explanation behind that question, then you will mark that question. Suppose, for example, even after doing it as per this approach, say question number 20 was very difficult, you don't understand the answer, mark that question in a sheet. Again, this is what my students have been doing from so many years, in a sheet known as difficult question sheet. Why? So that closer to the exam, on one piece of paper, you have all the questions that are hard for you. And you will keep practicing, keep practicing, keep practicing. You'll ask me to solve that question for you. I will solve it. You'll keep practicing, so that before the exam, your difficult question sheet becomes easy. And if your difficult questions, if they become easy, your easy questions are already easy, difficult questions also become easy. So what will happen to the exam? Become easier. So whatever question is difficult, says from this set of questions, question number 20 is difficult. Put it in the difficult question sheet and drop a message in the hotline number and say question number 20 from Kaplan Kit I need help with. We will upload that, make a video on that and send it to you. upload it on the LMS. And you've marked it in your difficult question sheet also. So you have multiple safeguards if you don't know the explanation to an answer. One, obviously look at the back of the kit. That itself has most of the time satisfactory explanation. If that does not happen, you can always let us know and we will explain that specific question and upload it on the LMS. So it becomes easy for you. But if you do it this way, your speed will really actually pick up. Once these set of 25 questions are over, move to the next set of 25 questions. Follow the same approach. Follow the same approach for the next 25 questions. Say, for example, for 50 questions. That is 25 to 50, follow the same approach. Suppose 35, question number 35, even after doing it as per this approach 3 times, if it is difficult, mark it in the DQS and let us know. We will upload the video for you. But when should you start the kit? You need to start the kit now itself. I want you to start Kaplan, BPP, Study Hub practice questions, everything now. By the time I finish the syllabus, textbook, Kaplan kit, BPP kit, Study Hub practice questions, Study Hub articles, because we'll be uploading videos even on articles. So Study Hub articles, Study Hub chapter-wise quiz, everything needs to be done before the syllabus is over. So suppose the syllabus is getting over on 15th of April. Right? Suppose, for example, it's getting over on 15th of April. By 15th of April, all of this needs to be done from your end. And for that, obviously, you will need to put in substantial amount of efforts. Because obviously, although we are there, practice you have to do. Articles after each chapter on your study hub, there are technical articles, which also need to be looked at. So guys, are we all confident that we will score exceptionally well in the FM paper? 100%, 200%. Let's try for a rank. I want 1 rank FM, 1 rank PM, 1 rank AA. Everybody should be our students. And for that, whatever support we want, we can give you, we will give. Okay. Anyway, now one thing I wanted to let you know is, again, from whoever gets a rank, will they get free class in the next attempt? Get the rank first, then we will definitely discuss. But you have to get world rank. Then maybe. Right? So again, guys, we have to make sure that we are trying to excel and get definitely a world rank. Whatever needs to be done for that, we will do it. Examiners reports, if we have to go through, whatever material we have to go through, we'll go through. But again, having said that, one thing that I wanted to tell you was that a couple of students felt that 3 hours is a little too long. They're not able to sit through. Okay. So again, some of you are working professionals. So obviously I'll not be able to bring down the class duration to 1 hour, because obviously the ones who are doing full time, 1 hour is too less for them. So what I felt was, in order to be fair to the quite a lot of students, FM, how many students? So in order to kind of cater to everybody's needs, we thought that the best we can do is kind of bring down the duration by 30 minutes, because 30 minutes is okay, no problem. I can still complete the syllabus manageable. Right? And yes, we will do that, Kittu. What Kittu is suggesting is we make the speed a little faster. Speed a little faster as in they should be able to adjust the speed. So 1x, 2x, sorry, not 1x, 2x, 1.5x, they're able to do that. Thank you, sir. Yeah. So again, please kind of be practicing the kit. So basically, this is what the LMS is. Okay, and anytime you get a test, the test will also be shown here. We will get a notification test here. So over here, you will get a notification that a test has been assigned. Okay, so you can access your test and immediately it will give you the answers. Sorry, not the answers, the result. With the answers, of course. Right, and where are we taking questions from? We're taking questions from, to start with, direct questions from Kaplan Kit, direct questions from BPP Kit, direct questions from Study Hub Practice platform. They're all direct questions because obviously the syllabus has just started. So I don't want to twist and turn questions and make difficult questions. So if you study the kits, you can score very well in these class tests. Okay, so again, we will upload BPP and that's it. BPP only is the thing that is yet to be uploaded because Study Hub, you have the access. Again, is there anybody who is not there on, hasn't been registered with ACCA? You don't have ACCA. This is why I felt this discussion was very important. You don't have access to the study hub. How come? Are you registered with ACCA, Anjana?
Yes, so I've registered through ACCA through my college, so we'll get the login ID by April.
Oh my God. April, that's okay. But when in April?
Around mid of April, that's what they said.
Okay, ideally, I would want you to start. But it's okay, no problem. Mid of April is about 15 days from now. So that's okay. Okay, so guys, again, what I feel is in order to, again, 97, right? So we will kind of keep short by 20 minutes and 4:30, which is now, what I will do is give you the review session. Review is basically we've done advanced and delayed annuities and perpetuities. Oh, IRR advanced. How come is this is green? We didn't do. Right. So review this. Perpetuities, we are yet to do a sum on perpetuities, delayed perpetuities. But apart from this, go through this, these things that are on the screen, and let me know how much is your understanding out of 5. So what I have seen here is one person is 4.5. It you don't need to go through the lecture again. I am here for you. Why are you 4.5? If you tell me, I can help you right now. And Nitesh is 4.9. Nitesh, why are you 4.9? Unless Kittu, you say that you had disconnection, you got disconnected, so that's why you want to watch the lecture again, then you can, no problem, you should. Nitesh, again, if you got disconnected, you were not able to hear me, definitely please watch the recording. Okay. Let's look again. These last 10 minutes are scheduled for your areas where you are not clear, you're not confident yet, not able to hear. Okay. So that's 4.9. So tell me, go through everything, and whatever you want me to explain again, I'll explain it now. No problem. We have time. Okay, Kittu, we're talking about advanced annuity. What is an advanced annuity? Advanced annuity is simply where, I'll just summarize so that not other people are also getting the benefit in a summarized way. Advanced annuity is what? Advanced annuity is basically, yes,
May you explain advanced perpetuity?
you want advanced perpetuity?
Yes, sir.
Yeah, okay. So advanced, so Kittu wants advanced annuity and delayed annuity, and you want advanced perpetuity. So advanced annuity is what? This is where the first amount in an annuity comes earlier than time one. Normally, Kittu, normally, Nitesh, you will get the first cash flow in time one, that is after 1 year. But what is an advanced annuity or advanced perpetuity? This is where you get the first cash flow in time zero itself. In time zero, that is now. In that case, what happens? In that case, again, you have advanced annuity. The easiest way to do it is, suppose you get, again, I use this same example, but suppose $600 you are to receive in this for 5 years. $600 for 5 years means this is an annuity. There is no doubt about it. There is no question about it that this is an annuity, because for 5 years, fixed amount you are getting for a fixed number of years. So there is no doubt it is an annuity. 200% it is an annuity. But the problem is the first amount, when is it paid? Now. The first 600 comes now at time zero. So what you will do is, think about it, there are 5 years, right? First payment you get now at time zero. Second payment you will get in time one, that is after 1 year. Third payment you will get after 2 years. Fourth payment you will get after 3 years. And fifth payment you will get after 4 years. Okay. Now what you will do is, for time one, Kittu, for time zero, Kittu and Nitesh, for time zero, this is money that you got now itself. You got today. And we've seen that the annuity factor or discount factor for any amount that is received today is always 1. And the annuity factor for the remaining 4 years will be calculated as usual. What do I mean by as usual?
Yes.
10% for 4 years. 10%, yes. 10% for 4 years is how much? If you see 10% for 4 years, the annuity factor will be 3.17. Therefore, 3.17 is the annuity factor. Plus, for the first period, the annuity factor is 1. So the total annuity factor for all the 5 years is 4.17. which has to directly be multiplied with the cash flow. Because remember, future value into annuity factor is the present value. Annuity factor into future value is the present value. So 4.17 into 600. Nitesh, clear?
Yes, sir. Clear.
Kittu, clear? Very good. So that is how an annuity works. Okay. Next is with respect to advanced annuity. Advanced perpetuity works in the same way. You simply, to the perpetuity factor, have to add 1. Just have a look at this illustration. Just normally, amount to receive is 2000. The perpetuity factor is 1 divided by R. To that, you just have to add 1. That's all. Okay, so advanced annuity and advanced perpetuity is done. Now, I think what I will do is I will first explain delayed perpetuities, not delayed annuities, because there was a sum which Osama wanted me to practice, right? The sum was what? It was in delayed perpetuities. First of all, what do I mean by a delayed perpetuity? Where is delayed perpetuity? Here. What do I mean by a delayed perpetuity? Delayed annuity or perpetuity, whatever it is. See, normally you have to get the money from the first year. T1, T2, T3, T4, T5. But sometimes the cash flow will start coming in not from the first year, not from T1. You will get it later, maybe in T2 or in T3 or in T4 or in T5. When you don't get your first cash flow in T1 and it is delayed, that kind of annuity or perpetuity is known as delayed annuity or delayed perpetuity. Is this clear, Kittu and Nitish?
Yes, sir.
Now we're looking at, again, how do you calculate a delayed annuity? Okay. Sorry, delayed perpetuity. A perpetuity of 14,000 starts in 10 years' time. So it's a delayed perpetuity because you're not getting in T1, you're getting this perpetuity from T10. So it's a delayed perpetuity and interest rate is 12.5. First and foremost, you need to understand perpetuity factor is 1 divided by R. So let's know the perpetuity factor. Factor is 1 divided by R. R here is 12%. So perpetuity factor 1 divided by 12.5% is 1 divided by 0.125, which is 8. Which is 8. So you got the perpetuity factor. Okay. What you will do is, again, treat this as usual. What do I mean by treat this as usual? How much are you getting? 14,000 into 14,000 is the cash flow. And you will discount it as usual. Normally, if there's a perpetuity factor, you'll simply multiply the cash flow with the perpetuity factor. So you've normally calculated the what? The present value of this cash flow. In a usual way, you have calculated the present value of this cash flow. Very good, Kittu. Now what happens? Remember that the first payment is happening in 10 years' time. First payment is happening in 10 years' time. So this amount that you got, it is literally giving you the present value in time 9. It's okay if you didn't understand, it's completely fine. But step 1 is to calculate the present value as usual. You calculated the present value as usual. Then you realize, oh, this is money you're getting in 10 years. And you calculated it as usual. So your T10 is like your T1. In this case, your T10 is like your T1. So obviously, your T9 is like your T0. So basically, this 112,000 is the present value in T9. That is, after 9 years, it's like you are getting how much? 112,000 after 9 years. So as usual now, Osama, you will do the discounting and find the present value. So 112,000 is the value after 9 years. Use the discount factor. 9 years at how much? 12.5%. It should be how much? Again, we will refer the 0.346. Yes, Nitish. So 0.346. So the present value as per today's date is 112,000 into 0.346 will be 38,752. Osama, this is clear how to discount delayed perpetuities? The same way as delayed annuities. Whatever it is, guys, delayed annuities and delayed perpetuities, what is happening is you get the money later. Suppose, for example, normally you're supposed to get it in time 1, you're supposed to get it normally, the cash flow. But in delayed annuity or perpetuity, the way is the same. Method for both is the same. In delayed annuity or delayed perpetuity, suppose you're getting it from time 3 onwards. What is the first step? The first step is to assume the previous period. So we'll assume time 3 becomes our pseudo time 1. Pseudo means false. False time 1. This becomes our false time 2. Assuming false time 3. So obviously the pseudo time 2, time 2 will become pseudo time 0, false time 0. The first step is to assume that T3 is the first year. So obviously T2 will become now. Calculate the present value of the annuity or perpetuity. The way you deal with both is the same. In the usual way. In the usual way, you calculate. Once you get that, you will get the present value you will get the present value here. You will get a present value here. Whatever it is, maybe it is 121. I'm giving an example. Maybe it's 121, but it is actually the present value at time 2. So what is the most smart thing to do? It's like saying you're getting 121 after 2 years. So what is the value of that today? So as usual, what you will do is you will get the present value at time 2. So now, as usual, discount the amount as usual using the discount factor to get the present value at time 0. So suppose, for example, at time 2, the present value of this annuity, suppose it is 100. So from time 0 point of view, it's saying that 2 years from now, you're getting 100. So how do you discount it? 100 into the discount factor of 2 years. That's it. So clear, Osama, Nitish, and Kittu? So basically, we've completed delayed annuities, perpetuities, advanced annuities, perpetuities. So Nitish, are you 5 out of 5 now? Okay, that's all, guys. So again, from the coming class onwards, we will stop at 4:30, and from 4:30 to 4:40, we will do the review session. Okay, that is all, guys. Thank you so much. You can leave.
Thank you, sir.
Make
Bye.
sure you're studying for the test on Friday. Friday test will have everything that I cover till then. Okay, all the best.